Today in this episode, I have two stocks for you guys to look out for, whether you're using Wealthsimple or Robinhood or any other trading platform within Canada or the US. In these two stocks, one of these I've made a video on previously on my channel, and no, it's not Shopify. However, it is a growth stock, and the other stock is a bit of a dividend play which I recently added to my portfolio. If you enjoy this kind of video where I do a deeper dive into two different stocks, one dividend and one growth stock, please just smash that thumbs up button to let me know that I should continue making these kind of videos. Welcome back to the Fire Grind. My name is Daniel, and on this channel we talk about personal finance, and we have a focus on the stock market as a way that we can build wealth and achieve financial independence. On today's episode, as I mentioned, we're going to be going over two different stocks, and I'm not going to make you wait to know what these two stocks are. The first stock that we're going to go over is Canada Goose, and previously I've done a video on Canada Goose before this whole market crash happened. If you want to check out my thoughts before this market crash, you can click the link up here after you watch this video, and you can kind of compare how I view the company back then and how I view it right now. And the second company that we have is Tfi International, and this is a new holding of mine, and this is a dividend play stock. This company, they're in the trucking and logistics space, and it's very interesting as I dove into this company, just looking at their quarterly earnings reports as well as management's discussion on how their business is doing. And I have some very interesting information to share with you guys in terms of how the trucking business relates to the overall economy and what management has been seeing in the past few weeks, especially as the economy was shutting down. So we have a lot to cover in this video, and let's dive right in, starting off with Canada Goose first. If you guys don't know what Canada Goose is, they're a Canadian retailer of luxury parkas, and they're actually expanding out into different sectors, such as they're making knitwear now, as well as they recently acquired a shoe company called Baffin. So they're kind of expanding their business into other types of clothing that are related to winter wear or just warm clothing. And in terms of how they're doing financially and the history of the company, they recently IPO'd in 2015, and since then the stock actually skyrocketed up to around $90 Canadian, and since then has fallen back to around $30 today, and at its lowest it actually fell down to about $18. But in terms of the growth and the financials of the company has actually been doing very well over the years. They have increased their margins from 47% all the way to 62% as of today. This means that their gross profits and revenues are increasing quicker than the cost of goods sold. And not many companies can actually shift from a 47% margin all the way to 62%, let alone even starting with a 47% margin is very rare. However, for luxury goods, this is a little bit more typical because they do mark up their products, and the fact that luxury goods, they don't sell as many of them, therefore they need to mark up the price in order to recuperate their development costs or just their design costs. And the reason for the shift in margins is because they've shifted from a wholesale model to a direct-to-consumer model. Initially, when Canada Goose started out as a small brand, they went to wholesalers such as the Bay or maybe Nordstrom or some other sports stores like Dick's or Sport Chek, where they would sell their jackets to them in bulk, and these retailers would help Canada Goose market their jackets and hire sales associates to represent the product. So it was a lot less work for Canada Goose in terms of the sales and general administration side of the business. However, they've shifted over to the direct-to-consumer model because now the brand is well known enough and they're able to open up their own stores, and by doing so they're able to capture more profits from each jacket that they sell or each product that they sell. And they heavily pushed into direct-to-consumer from 2017 to 2018, and we can see this is where the largest jump in margin happened. They actually went from a 52% margin to a 58% margin. Another thing to note about Canada Goose is they're actually a profitable company, and not many growth companies are profitable. And the reason for this is those growth companies typically take their revenue and throw it back into the business in the form of advertising, hiring more people, expanding store count, expanding corporate retail offices, and they use this to accelerate their revenue. However, Canada Goose didn't take on the strategy of trying to expand too rapidly in terms of their manpower or advertising budgets. And I think the reason for this is because they're in the luxury space. And when you're in the luxury space, you don't want to flood the market with your product. Otherwise, too many people will own your products and it will become less special for those who own it. So therefore, Canada Goose tries to restrict the number of products that they sell so that their product is not very common out there, and the people who buy it, they kind of feel special when they wear the products. So it's just like if you were to buy a Rolex watch, not many people can afford a Rolex watch, and therefore if you're able to afford it, you feel something good about that purchase when you wear it and other people see it, because they're like, dang boy, you made it. The way that Canada Goose is expanding their business is that they're slowly growing their market share and penetrating new markets such as China or further into the US or even Europe, for example. And in addition to that, they're expanding the product line from just parkas into knitwear as well as shoes, which I mentioned earlier with their acquisition of Baffin. Canada Goose is able to use their parkas and what they're known for to cross-sell their knitwear and as well as shoes, because basically these items complement each other, and if Canada Goose wants to capture in onto the customers, Canada Goose is also going to market other products that they offer that go with the style of their coats. Now turning over to the balance sheet to see the health of this company, we can see they have a current ratio of 2.28, which is actually quite healthy. But if you dig into it a little bit deeper, their cash ratio is only 0.28. And this was a little worrisome for me looking into this company recently, because with the whole downturn in the economy, Canada Goose still has to continue to pay their bills. And with a 0.28 ratio, this essentially is saying that they could probably last for about a quarter of a year, or if they don't turn any revenue at all. However, I do believe in Canada Goose that they're going to still continue to push out e-commerce sales, and if they really need to, they probably have a line of credit that they can draw from to help them in the near term. And the reason why their current ratio is a lot larger than the cash ratio is because they have a lot of their current assets in inventory. And this was a big pain point for investors, and this started to happen in 2019 when investors saw that the inventory was starting to balloon. And as an investor, you really don't want to see this, because that means the company is manufacturing more than it can actually sell. But Canada Goose's management gave a reason for this. It's because they're shifting from outsourcing their manufacturing to bringing their manufacturing in-house. And what this means for their supply chain and their product flow is that they need to be able to continue to supply products to their customers as they're trying to figure out their in-house manufacturing. So they're able to cut off their outsourcing manufacturing sooner by having larger amounts of inventory to be able to backfill orders as they're trying to figure out their in-house manufacturing. Typically when you're setting up in-house manufacturing, there's going to be a lot of hiccups, such as machinery going down, or people trying to learn new processes, or just uphauling different processes to make them more efficient, or moving machinery around to get the best configuration to pump out the maximum amount of coats for the number of people that you hire. So these are all the growing pains of bringing manufacturing in-house that Canada Goose has to deal with, and therefore management has said that they're increasing inventories to be able to help them through this transition from outsourcing manufacturing to bringing it in-house. And this will only accelerate their profits and their gross margins, because if they're able to bring the manufacturing in-house, they don't need to pay a third-party company who also needs to make profits the money to manufacture their coats, and that company will take a bit of a cut. Rather, Canada Goose will bring that in-house and they'll take the extra margins. And I believe Canada Goose started to shift towards an in-house manufacturing because they're seeing the demand for their products go up. And this only makes sense that they bring their manufacturing in-house because they know the demand for the product, and they're able to balance the supply that they're creating from their in-house manufacturing to service that demand that they have modeled. But we can see the general investor and the institutional investors, they didn't exactly buy the story from management, and therefore the stock really sold off February of 2019. And since then it's dropped from $90 all the way to the lows in March around $18 per share. And that's in Canadian dollars. And we can see with the dramatic drop in shares, their PE ratio actually went down over time. And if we use a favorite tool of mine called Wolfram Alpha, you can use this tool to type in company name plus PE ratio or other metrics, and Wolfram Alpha will show you the trend over the past 5, 10 years, or even 1 month if you're interested in that. So definitely check out Wolfram Alpha. I'm not affiliated with them. I actually use them for my schooling to figure out equations, but I found out recently that you can actually use their platform to get stats on different stocks. So with Canada Goose's falling PE ratio, to me this just screams that Canada Goose is becoming more and more undervalued based off of the growth prospects that they have in the future. Another tool that I like to use for research into consumer retail companies is Google Trends. And let me tell you why Google Trends is amazing. Basically in Google Trends, how I use it is I type in different brands or product names, and Google will spit out how the search volume has been over the past 5 years, 12 months, or since 2004. And for Canada Goose, I typed it in just to see what the consumer search volume is like for Canada Goose. And it's been trending up steadily and almost in an exponential fashion. And I'll pop this up on the screen to show you Canada Goose's trend over time in the past 5 years. You can see the growth has been exponential. And the next graph I'm going to show is Canada Goose compared to other brands within their niche. So brands like Patagonia, the North Face, Columbia Sportswear, or Arc'teryx. We can see that Canada Goose isn't yet the biggest player, however they are the fastest growing player. They actually beat out Arc'teryx back in around 2015 when they IPO'd, and as well as they're catching up to Patagonia, and sooner or later they might even catch up to North Face or Columbia. However, I'm not exactly sure if they will, because North Face and Columbia, they're more for the mid-tier to even lower tier jackets, and they do offer some higher end jackets, but they're not exactly in the same luxury space, so their search volume will tend to be higher than Canada Goose on the whole. Canada Goose has recently faced some headwinds in 2019, but it's not just Canada Goose who's faced this. We can see that all the other coat retailers had a bit of a decline in search volume, so this is probably just a broader market macroeconomic effect that's taking play for luxury parkas. Maybe it's due to a bit of climate change and the weather's getting a little warmer, so there's less search volume, or people are just spending less on luxury parkas. I don't exactly know what the reason is, so if you guys know, let me know in the comments down below what your thoughts are on this decline in the luxury parka market. But I'm not too worried in terms of future growth for Canada Goose, even though Google search volume is declining from 2018 to 2019. However, I think it will start to pick up, and I think Google search doesn't actually show the search volume in China because Google is not available in China. And Canada Goose recently actually opened stores in China, I believe in 2019 or so. Those stores are definitely going to do well over the years because China is the largest luxury goods market. So Canada Goose, they've been only selling in Canada or the States, and really this is the tip of the iceberg for them, I think. When they really expand into China, we can see that Canada Goose is going to do well over the long term there. And they've already reported a bit of results when China was doing okay in terms of economy. They had a great sale during the Singles Day in November last year to the broader Chinese market. They actually were one of the top grossing brands on Tmall. So once everyone starts to come out of hiding and people get to go back out and shopping, Canada Goose's sales would definitely accelerate. And the good thing for Canada Goose right now is that summer season is approaching, so this is their slump time, and management knows this, and this is when they start to build up inventory. So really Canada Goose's business is not going to be impacted as much by the recent pandemic going into the summer. And I believe that we will recover from this pandemic and businesses will start to open up in the next few months, and especially when fall time comes around, we should be back to somewhat normal. So I believe Canada Goose will be able to take flight again in the fall. And one other thing to note about this stock is that currently there's a 22% short interest, and if Canada Goose releases any sort of good news that is worrying for the bears, their stock is going to have somewhat of a short squeeze, and this is going to cause the price to skyrocket. And you can usually see this in stocks that are very volatile, like Tesla, where there's some sort of good news that happens and the stock rises for 10% every day for the next week or so because shorts are trying to cover their position. So I believe that once Canada Goose shows signs of growth again, these shorts are going to get hammered hard and shareholders are going to be rewarded by this. Also note that their quarterly earnings are going to be coming out in the month of May, so be sure to check them out if you're interested in the stock to see what management has to say about the pandemic's impact on their sales, and especially how their e-commerce business is doing in this time. This video is getting a little bit long, so I decided to split it into two parts. So check out part 2 of this video by clicking the link in the top right.